For the past 2 years, investors have been obsessed with one question: has the semiconductor industry finally recovered? Most people looked at Nvidia. Others watched TSMC. But during its latest earnings call, UMC may have revealed something even more important. Not because of its earnings beat or revenue numbers, but because management is making decisions that suggest they see a very different future for semiconductor demand. They're increasing capital spending, expanding manufacturing capacity, and signaling growing confidence in markets far beyond the AI headlines. So, is UMC simply preparing for a normal cyclical recovery? Or are we witnessing the early stages of the next semiconductor boom? In this video, we'll look beyond the headline numbers, examine what management is really telling investors, and explore why UMC's latest outlook could matter for the entire semiconductor industry. At first glance, UMC's latest earnings appeared relatively solid, with stable revenue and resilient profitability. But for long-term investors, the quarterly numbers were not the most important takeaway. In the semiconductor industry, earnings reflect where the business has been, while management's outlook often reveals where demand is heading next. During the earnings call, executives placed greater emphasis on customer demand, capacity planning, utilization trends, and future investment than on the quarter's financial results. They also increased their capital expenditure plan and continued expanding manufacturing capacity in Taiwan and Singapore. Those are strategic decisions that typically reflect confidence in future demand, not caution. So before we examine where the semiconductor industry may be heading, we first need to understand why UMC's management is becoming more confident about the future. The biggest change wasn't in UMC's quarterly earnings, it was in management's view of the market. During the earnings call, the company described demand as continuing to improve across several end markets, supported by healthier customer inventory levels and stronger wafer loading. Rather than relying on a single growth engine, UMC pointed to a broader recovery that includes communications, automotive, industrial, and computing applications. At the same time, management reiterated its confidence by maintaining its expansion plans despite an uncertain macroeconomic environment. For equity investors, this matters because semiconductor recoveries typically become more durable when demand broadens across multiple industries instead of depending on one segment alone. The next question is, what evidence convinced UMC that this recovery is becoming more sustainable? Management's confidence isn't based on optimism alone, it is supported by changes in customer behavior. During the earnings call, UMC highlighted improving wafer demand, healthier inventory levels, and stronger fab utilization as customers gradually resume normal ordering patterns. This is an important shift because the semiconductor industry has spent the past 2 years working through excess inventory after the post-pandemic slowdown. When inventories normalize, customers no longer rely on existing stock and must return to foundries with new orders. That's often one of the earliest signals that the industry is moving into a new phase of the cycle. But if demand is improving, the next question becomes even more important: where is this demand actually coming from? One of the biggest misconceptions is that semiconductor demand today is driven almost entirely by AI. UMC's outlook suggests a much broader picture. Management pointed to improving demand across communications, automotive, industrial, and computing applications, not just AI-related products. This matters because a broad-based recovery is typically more sustainable than one fueled by a single technology trend. Mature node chips remain essential for power management, connectivity, image sensors, display drivers, and thousands of other components used in everyday electronics and vehicles. In other words, while AI may dominate the headlines, it is the recovery across multiple end markets that gives foundries like UMC greater confidence. And that raises the next question: if demand is broadening, why is UMC investing so aggressively right now? One of the strongest signals from UMC's earnings wasn't found in the income statement, it was in its investment plans. The company raised its 2026 capital expenditure and continued expanding manufacturing capacity in both Taiwan and Singapore. These projects require significant capital and years to complete, so management cannot afford to base them on short-term optimism. Instead, they reflect expectations that customer demand will remain strong well beyond the next quarter. For long-term investors, this is an important distinction. Earnings tell us how the business performed today, but capital allocation often reveals what management believes the market will look like several years from now. So, what exactly is UMC preparing for that justifies such a long-term commitment? This brings us to the most important question in UMC's investment case. Is the industry simply recovering from a downturn, or are we entering a new phase of long-term demand? Historically, semiconductor cycles have been driven by inventory corrections followed by a recovery in consumer electronics. But today's environment looks different. AI infrastructure is expanding rapidly, vehicles continue to require more semiconductor content, industrial automation is accelerating, and connected devices are becoming more widespread. These trends don't replace the traditional cycle, they extend it by creating new sources of demand. That helps explain why management appears confident enough to invest through uncertainty. But every investment thesis depends on one critical assumption: what could prevent this recovery from playing out as expected? Despite the improving outlook, UMC's story is far from risk-free. The biggest challenge is that semiconductor demand has always been cyclical, and a slower global economy could delay customer orders once again. At the same time, continued capacity expansion across the industry raises the risk of oversupply, which could put pressure on wafer pricing and utilization rates. Geopolitical tensions also remain an important consideration, particularly as semiconductor supply chains become increasingly strategic. Finally, while AI is creating new demand, there is no guarantee that every part of the semiconductor industry will benefit equally or at the same pace. So after weighing both the opportunities and the risks, the key question becomes, is the market pricing UMC's future correctly, or is it overlooking something important? Today, much of the market's attention remains concentrated on companies leading the race for the most advanced chips. But UMC isn't trying to compete in that space. Its strategy is built around mature node manufacturing, where long product life cycles, stable customer relationships, and broad industrial demand can create resilient cash flows. If the semiconductor recovery continues to expand beyond AI accelerators into automotive, industrial, communications, and embedded applications, the companies supporting those markets could benefit more than investors currently expect. In other words, the opportunity isn't about becoming the next AI leader, it's about being an essential part of a much larger semiconductor ecosystem. And that leads to the final question: what should investors watch next to determine whether this thesis is actually playing out? Going forward, I won't be focusing only on UMC's earnings per share or quarterly revenue. Instead, I'll be watching the indicators that reveal whether management's confidence is translating into real business momentum. That includes wafer utilization rates, customer order trends, monthly revenue growth, and whether capital spending remains on schedule. I'll also pay close attention to commentary on automotive, industrial, and communications demand, as these markets will determine whether the recovery is becoming broad-based rather than AI-driven alone. If these indicators continue to improve over the next several quarters, it would strengthen the case that UMC is preparing for more than just a temporary rebound. And that brings us to the investment thesis. UMC's latest earnings may not have changed the semiconductor industry overnight, but they may have changed how investors should think about its future. The most important message wasn't the quarterly results, it was management's growing confidence in customer demand, capacity expansion, and the next phase of the industry cycle. Whether that optimism proves correct will depend on execution, end market demand, and broader economic conditions. But one thing is already becoming clear: the semiconductor story is expanding beyond a handful of AI leaders. If demand continues to broaden across automotive, industrial, communications, and computing, companies like UMC could become larger beneficiaries than the market currently expects. That's why the next few quarters may matter far more than the last one. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.